General insurance. Definition: this is called property and casualty insurance in North America, and can also be called short-term insurance because the contracts are reviewed annually, or even after shorter period. General insurance policies are indemnity contract. In most cases, each policy has a sum insured on which the premium is based and which places an upper bound on the claim. The insurance, however, only indemnifies the policyholder against financial losses, so the actual claim amount may be smaller than the sum insured. If the sum insured is less than the maximum loss possible, then the policyholder is underinsured and the insurer will apply average and reduce the claim in the ratio of the sum insured to the maximum loss. To reduce the level of claims, and virtually eliminate small claims, there is likely to be an excess, or first amount payable by the insured, also called deductible. Many product, particularly motor insurance, will also qualify for no-claims discount, also called a no-claims bonus, that can see premium reduced by half or better. Insurance may be for all perils or provide exclusions of fire, flood, theft, civil commotion, accidents or landslip, which could include earthquake. The excluded events are insurable or either because of their potential catastrophic impact on the insurer's solvency or because of moral hazards. The insured either knows more about the risk than the insurer or may the incentive to take proper precautions if the insurer bears the risk. Home insurance. This includes homeowners and householder or building and contents insurance. They cover the house or apartment itself and its contents respectively. More valuable items such as jewelry need to be covered separately and present more difficult moral hazards. How do you prove you have lost the diamond out of your engagement ring? The general insurance contract are often long and complicated. It is difficult for the insured to understand the extent of their cover. Example: flood damage may be excluded if it arises from rising water levels but not from falling rain. The challenge is to find ways of providing clients with the necessary cover at the right price. In the case of flood exclusions, the reason may be the difficulty of identifying low-lying properties that are particularly exposed. Arguments can be made that charging them the much higher premiums that would be necessary to give adequate cover would be unfair. A counter-argument is that not telling the owners that their properties are at significant risk is also unfair. Motor. This can cover losses or damage to the policyholder's car and any damage to the person or the car of any third party. Compulsory third-party (CTP) insurance to cover death, disability and medical insurance is commonly required by the governments, perhaps because motor accidents are potentially lethal and a properly designed schemajon reduce wasteful litigation as to blame and a quantum of damages. In some countries, CTP insurance is subcontracted to private companies. In others, the costs are included in the price of fuel, on the basis that a driver's risk is related to the distance driven. Personal accidents. This is strictly life or disability cover, but limited to losses caused by accident. Short-term insurer can offer it because the risks do not generally increase with age. It may, however, be difficult to integrate with insurance for other causes such as sickness, leaving people with insurance gaps or excessive entitlements for benefits arising from the accident. Liability insurance – cover against claims arising as a consequence of unsafe workplaces or products and negligent practices. This includes professional indemnity and directors' and officers' insurance that provide cover against claims for work-related negligence. Credit insurance or trade credit insurance covers against debtors failing to make payments, which is especially attractive for exporters who cannot analyze their customers' creditworthiness easily. Reinsurance insurance, for insurers' surety bonds insurance, purchased by securitized vehicles seeking to enhance their credit ratings. Marine insurance, covering ships, aircraft and goods in transit. Fire and other property cover, with the obvious meaning business interruption insurance, cover against loss of revenue arising as a consequence of other losses. Business insurance organizations sometimes buy insurance cover that does not appear to be strictly necessary given the risks to which they are exposed. Tax and regulatory arbitrage can be a motivation. Insurance premium can often be paid to companies in low-tax jurisdictions that may also require less capital for the same risks. The international conglomerate, which may well own the captive insurer, thus earns a higher profit on lower capital. Insurance can also be a form of outsourcing. The insurer may know a lot more about the evaluation and management of the risk concerned, leaving the company's management free to concentrate on the job they do best. Most countries require employers to take out workers' compensation insurance to provide life, disability and medical cover for job-related injuries. The objective is to protect workers and employers who might have to meet very large claims. As with compulsory third-party motor insurance, such schemes can also reduce unfruitful litigation, but invariably fail to provide cover for other causes of injury or death. Thank you. Thank you.